Hi, this is George. In this video, we are going to see the journey of an option trader. That is, how a trader or investor enters the stock market and how he starts with maybe like trading with some other instruments. Then slowly he gains confidence and knowledge and enters into options. So, usually whenever a person enters into stock market, he just buy a equity. Equity is nothing but a company's stock that is trading in the exchange. He might have entered by gaining like knowledge from others, like they might have given a recommendation, or he would have read from a newspaper or something, and he would have entered the stock market by buying a share, and if it gains profit, then he will sell that. That is how generally a trader's journey begins. Then slowly he will understand that like buying a stock and selling will not be like he will not get a consistent profit, and he won't be able to make big bucks with this. So it will be like little difficult in trading only on equities. Like if he is planning for it to be a long term, or like in like thinking, okay, let me hold this for 3 months or 6 months. Once it like it gains 10-20%, then I can sell. With that intention, if he comes, then if it doesn't happen, then he might think like, okay, this he will lose the faith in that, and he might think we'll do something else other than just with equities. In that time, he will think of intraday play. That is nothing but he might have like 50,000 in his account. He might take a stock which is 5,000. He might buy like 1,000 stocks, 100 stocks, whatever it is, and he will sell it if it goes to 51 or 52 rupees. So if it is, let's say, 1,000 quantities, then for just 1 rupee gain, you get 1,000 rupees. So if it goes to 2 rupees, then it is 2,000 rupees. So as you know, like all the stocks in the exchange like moves 1 or 2 rupees here and there every day. So they might think of that. But again, this is very difficult to trade because you cannot make consistent profit in that, and you might not be able to make profit as well. You might think it will go up 1 2 rupees, but it might go in the downside of 1 2 rupees, in which you might have to lose the money. So then finally they'll think, okay, this is also not working out for me. Then by the time they are in equity for some quite some time, they'll get to know about options. So there are two things in options. You can be an option buyer or you can be an option seller. It's not something like only if you have an option contract you can sell. Even without having an option contract you can sell. That is called option seller. That will come to next. So option buyer. So option buyer is something which option trader will first enter, because in this there is limited risk and unlimited profit. Say suppose if you are buying an option contract for 1,000 rupees, even it can go to 10,000, even it can go to 1 lakh or even 10 lakh. These are like very rare scenarios, but probability is there. So with very limited risk, you can take unlimited profit. Let me just show an example on this. So I'll show this application. This is an Opstra application. This is a paid application. I don't say that as a beginner you need to have this application, but it is totally up to you. If you want, you can definitely buy this, and you can do virtual trading, and you can like learn like how the historical prices has moved. So in this example, let me show you. 1st February, this is here we are giving the bank nifty or nifty, the indices number, indices name, and here you'll give the start date and the payoff date, which is the end date where you think the expiry. I'll come to this expiry also later. So now you see like 1st of February, mark bank nifty is trading at 38,500. So now you are thinking like by month end, that is 24th of February, the last Thursday is called as expiry date. So you are thinking like it will go in the downside. So you are going to take a put option. Put option is something in which if you think like market will go down, you can buy a put option. Put option. If you think market will go up, you'll buy a call option. So this side, left side is call option, and right side is put option. You can just see the strike price, which is the trading price. If you see here, it is 38,500. So you have to find where is 38,500 in this strike column. And prices is called premium. Call LTP, call last traded price, and put last traded price. You can just ignore these in between columns for now. So now you are going to buy 38,500 put option. Let's see what is the price of 38,500 put option. So 38,500 put option is 1,023. So in this, it is trading at 1,023, and by 24th of February, the same, you can see market has went to 36,400, but the 38,500 that you bought is trading at 2050. So here you have bought at 1023 and you are selling at 2050. So your profit is 1027 for one lot. One lot is actually 25 units in Bank Nifty. It differs from each indices and each stocks. For Bank Nifty, it is 25. So now your profit will be 1027 into 25, which is almost 25,000. Here your investment was 25,000 and your profit is 25,000. So you have invested 25,000 and you are taking out 50,000, which means your profit is again 25,000. You have multiplied your money in just a month. Let me take but if it goes wrong in this case, you have spent 25,000, and if your view went wrong, you will be losing all the entire 25,000. So in that case, what you can do is like you need not trade for a longer time period. You can just take one day before of 24th February. So 23rd February, you can see market was at 37,600 that I have quoted here. So 37,600 put option was trading at 294. We'll just check that. 37,600 put. It is trading at somewhere around 300. Now you are thinking it will go down. Let's see what it had happened on the 24th. 24th, as you know, it was went to 36,400. This is the day where Ukraine-Russia war crisis came. So market drastically fell. Now the 37,600 that you bought has become almost 1,200, which is 4 times. So whatever you bought, like you bought for 300, 300 into 25, you would have invested 7,500. Now it has become fourfold, so it would have reached 30,000 now. So you have gained profit of 22,500. But these cases are like very rare, and I am giving you these examples just to give you like confidence, or maybe so that you will feel like okay, there is a potential to earn. So that is the only reason I'm quoting these examples, but most of this times this won't happen and you will be on a losing side. As I have given the next point, probability is not in the favor of option buyer. So if you see, if you throw a toss, the probability of you getting a head or tail is equal to 50%. But in case of options, the buyer's probability of getting a profit is very limited, maybe around 5 to 10%. An option seller are the one who have people who actually make money in options. Let me tell you a few myths on option seller. What they sell about option selling is they say like it is unlimited risk and very limited profit, and the risk can be like so much you won't be able to manage that. You always have to have like so much trading psychology should be there, trading discipline should be there. Of course it should be there, but if you have some consistent way of earning money, then you can develop some skills to garner that. So I will say like option selling is relatively easy than option buying. Here you need not know so many things than what an option buyer should know. So I will always recommend you to be an option seller. So in options instrument, like even if you don't have an option contract, you can be a seller. Say suppose you can in a real life scenario, if you see if you are running some shop, you cannot sell something that you don't have. But that's not in the case of options trading in stock market. Even if you don't have a bank nifty instrument or any stock or anything on options, you can still sell that. That is called as option writing. So option sellers are nothing but option writers. So let me just show you an example why I am asking you to be an option seller and why I'm saying that you get a consistent profit and you have a more probability. Say we'll take the same date of 24th February. So the strike price is 36,400, and just show you what was the price in the morning 9:20 a.m. Usually stock market opens at 9:15 and ends by 3:30. So now it's 9:20, like 5 minutes from the start. 36,400. So 36,400 price of call is 300 and put is 250. And you can see like whichever is above 36,400 in call options are having very big premium, and which are all having, which is like lesser than 36,400 is also having premium of till at least 10 rupees till 37,900 strike price. Similarly 36,400 to 34,500, you can see some premium at least 10 rupees, and it gradually increases till 36,400 and it keeps going on. Now by the same date around 3:20, where the market ends at 3:30, if you see what is the premium prices, that time The market has went to 3500. So we'll just see what is the price of 3500 and above. In call option, if you see from 35 to 100, all the other options have become 0.7, 0.60, which is like 70 pies, 50 pies, 30 pies. Everything has decayed and everything is expired and it's becoming zero. Similarly, in the put option, anything above 35,000, you can see it is 1 rupees, 90 pies, 75 pies, 40 pies, 50 pies, everything will go to zero. So this is the reason I gave the topic as Thanos Snap. So every expiry of a contract, like how Thanos Snap will make everything disappear. Similarly, all the options that is trading will become expired due to time decay and those will become zero. So now if you are an option seller and if you have predicted something, okay, this option is going to become zero, you can in the morning you can sell that option and by around 3 o'clock you can buy that. Whichever premium you have sold, you would have sold for 100 rupees, that would have become zero. If you have sold for 200 rupees and if it was in your direction, it would have become zero. So definitely this is going to happen. Expiry will happen and definitely this will go to zero. So in this you can always get consistent profit if you like kind of be an option seller than option buyer. Option buyer, the probability is very low as I told before, but here you know definitely that there will be a decay and that will definitely going to happen. So if you see like so many people will take intraday trades on the expiry day. I will talk about what is expiry and all in a separate video and all these jargons like put option, call option, premium, expiry, option buying, all those concepts in the next video. But in this, what you need to know is like when the expiry happens, all the premiums will decay, which is like out of the money contracts. That is called as moneyness of a contract that I'll let you know in the next video. Okay. There are three things like ATM, ITM, OTM, at the money, in the money, and out of the money. Those things we'll see in the next video. But for now, you need to know like the Thanos snap will happen on every expiries, and by that day, all the expiries that you have sold will become zero. So you can be a seller and you can earn consistent money. Thank you.